Equity Mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity Mate.
Welcome to another episode of Equity Mates, a podcast where we help you learn to invest in roughly 20 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going, bro?
I'm very good, Bryce. Coming off an absolute high from our party last weekend.
What a ripper of a party.
It was good. It was good to meet some listeners. Thanks to everyone that came.
Yeah, big time. We had some down from Brisbane, made the trek all the way. Apologies, I've forgotten their name. We
had one listener from Perth.
Perth, yeah. Spanish, Milo from Spain.
Yeah, someone from Colombia.
Came from all over the world.
But I actually don't think they flew in from Spain and Colombia.
No,
I actually think the listener from Perth also had lived in Sydney for a while. But still, you know.
Yeah.
And then I was up from Melbourne, and actually a couple of our mates were up from Melbourne. So
yeah, I was in from the east. So
every corner of Australia and some global listeners as well.
Absolutely. So apologies to those down in Melbourne and Canberra and Brisbane and everywhere else that reached out and said they would like us to be doing a party up there. We do have an Australian party tour on the back burner, don't we, Ren?
We do. Look, honestly, every time we do an event like this, same when we did the live shows last year, it just makes me think, you know, we've got some really interesting listeners out there who are really engaged in the podcast, and you know, what if we just gave Equity Mates a red hot crack? But anyway, thoughts for another time.
For later.
Yeah.
No, it was good, and a massive thanks to everyone that came. And as we said on the night, it was a celebration of hitting the 100 plus episodes, and you know, a celebration of all the Equity Mates that have joined the journey along the way. So it was more of a celebration about them more than anything, because as you said in your speech, Ren, we literally couldn't be doing this if it weren't for everyone on the other side of the headphones. So a massive thanks.
Well, we could be, but we probably wouldn't be at this point.
Right.
2 and a bit years in. Anyway, from one celebration of investing to another.
Not sure about that.
Yeah, that works.
That was a segue.
That was a good segue.
Oh, God.
From one investing celebration to another. There was another big party on this weekend. Well, for some a party, for some a business trip.
If not the world's biggest, really, in this space.
Well, now it is, but soon enough, Equity Mates may be taking the mantle.
True.
Woodstock for capitalists. At least the Northern Hemisphere's Woodstock for capitalists will take the Southern Hemisphere's mantle. The Berkshire Hathaway annual meeting was over the weekend as well.
How good. So this is where once a year Warren Buffett and Charlie Munger, the two CEOs or whatever they are, the chief investing officers or heads of Berkshire Hathaway, come together and open up a full stadium. It is now, Ren. Tens of thousands of people come each year to a weekend of listening to Charles and Warren update on all things Berkshire Hathaway and their views on the market, and gives the listeners and gives the investors, I guess, a huge opportunity to ask a whole bunch of questions.
But which
is why we're here today.
You've tipped your hand there, because it does give our listeners an opportunity. So what happens generally is Warren and Charlie will sit on a stage and answer questions for, this year it was about 7.5 hours.
Gee.
So, you know, I think Charlie's close to 90 and Warren's in his 80s. So to have that kind of stamina is, you know, full credit.
Unbelievable.
We do 20-minute podcasts and we're exhausted. So, but you know, part of this podcast is we'll do some of the work, so you guys don't have to. And in that spirit, I am listening to the full 7.5 hours of Q&A. And what we've done in this episode, and we're going to pull it over to the next one as well, is we've pulled out some of our favourite questions and answers from Warren and Charlie to give you guys a taste of the biggest investing celebration of the year.
Yeah, epic. So don't worry about trying to find the stream for this, as Ren's, as you said, doing the hard yards. 7 hours slogging it out. Well, it's probably not a slog. It'd probably be quite
No,
enjoyable, to be honest.
it's been good. It's always very inspirational.
So let's get stuck in.
Yeah, so this episode's a little bit longer than our normal 20 minutes. We'll try and keep it under an hour. Most of it's going to be Warren and Charlie, so don't worry, you're not going to have to listen to us for that long. But in this first one, we've pulled out topics, everything from Warren and Charlie's thoughts on some of their big investments, and then recent things like Amazon, their thoughts on market change and change in the economy, and then we top it off with everyone's favorite topic, Bitcoin. So if you've ever wondered what Warren and Charlie think about Bitcoin, we've saved the best to last for you. So,
all right.
So to kick it off, one big topic in the market these days is share buybacks. So one of the first questions of the day was asking Warren and Charlie their thoughts on buybacks and when they'll buy back Berkshire's shares.
My question concerns your repurchase of Berkshire shares. In the third quarter of last year, you spent almost $1 billion buying Berkshire B stock at an average price of $207. But then you got to a period between December 26th and April 11th when the stock languished for almost 4 months under 207, and yet you purchased what I think of as a very limited amount of stock, even as you were sitting on an enormous pile of $112 billion. My question is why you did not repurchase a lot more stock, unless, of course, there was for a time an acquisition of, say, $80 billion to $90 billion on your radar.
Yeah, the question, whether we had $100 billion or $200 billion would not make a difference, or $50 billion, would not make a difference in our approach to repurchase of shares. We repurchase shares. We used to have a policy of tying it to book value, but that really became obsolete. It did not. The real thing is to buy stock, repurchase shares only when you think you're doing it at a price where the remaining shareholders are worth more the moment after you repurchased it than they were the moment before. It's very much like if you were running a partnership and you had 3 partners in it, and the business was worth $3 million, and one of the partners came and said, "I'd like you to buy back my share of the partnership for $1 billion." I started out with millions. I'll stay with millions. For $1.1 million, and we'd say, "Forget it." And if he said $1 million, we'd probably say, "Forget it." And if he said $900,000, we'd take it, because at that point, the remaining business would be worth $2 million, and we'd have 2 owners, and our interest in value would have gone from $1 million to $1,050,000. So it's very simple arithmetic. Most companies adopt repurchase programs, and they just say, "We're going to spend so much." That's like saying we're going to buy XYZ stock, and we're going to spend so much, or we're going to buy a company, and we're going to spend whatever it takes. We will buy stock when we think it is selling below a conservative estimate of its intrinsic value. Now, the intrinsic value is not a specific point. It's probably a range in my mind that might have a band, maybe of 10%. Charlie would have a band in his mind, and it would probably be 10%. And ours would not be identical, but they'd be very close. And sometimes he might figure a bit higher than I do, a bit lower. But we want to be sure when we repurchase shares that those people who have not sold shares are better off than they were before we repurchased them. And it's very simple.
So that's part one of an answer Warren gave on buybacks. We've snipped out the next little bit from another question on buybacks, just for the sake of completeness. So here's Warren further explaining his thoughts on stock buybacks and how that sort of returns money to shareholders.
We really want the stock, ideally, if we could do it, if we were small, once a year we'd have a price, and we'd do it like a private company, and it would be a fair price, and people who wanted to get out could get out, and if other people wanted to buy their interest, fine, and if they didn't, and we thought the price was fair, we'd have the company repurchase it. We can't do that, but we don't want the stock to be either significantly underpriced or significantly overpriced, and we're probably unique on the overpriced part of it, but we don't want it. I do not want the stock selling at twice as what it's worth, because I'm going to disappoint people. We can't make it. There's no magic formula to make a stock worth what it's selling for if it sells for way too much. We don't, from a commercial standpoint, if it's selling very cheap, we have to like it and we repurchase it. But ideally, we would hope the stock would sell in a range that more or less is its intrinsic value, business value. We have no desire to hype it in any way, and we have no desire to depress it so we can repurchase it cheap. But the nature of markets is that things get overpriced and they get underpriced, and we will, if it's underpriced, we'll take advantage of it.
Nice. So moving on from buybacks, we now have a dad asking a question on behalf of his kid, and he has asked the guys what is their most interesting or fun investment.
Brooke is a proud Berkshire shareholder and read the letter and had some questions regarding investments that have been made in the past. And she had made some interesting comments about what she thought was a lot of fun. So our question for both of you is, outside of Berkshire Hathaway, what is the most interesting or fun personal investment you have ever made?
Well, they're always more fun when you make a lot of money off of them. Well, one time I bought one share of stock in the Atled Corp. That's spelled A-T-L-E-D. And Atled had 98 shares outstanding, and I bought one. And not what you call a liquid security. And Atled happened to be the word Delta spelled backwards. And 100 guys in St. Louis had each chipped in $50 or $100 or something to form a duck club in Louisiana, and they bought some land down there. The two guys didn't come up with there were 100 of them. Two of them defaulted on their obligation to come up with $100. So there were 98 shares out. And they went down to Louisiana, and they shot some ducks, but apparently somebody fired a few shots into the ground, and oil spurted out, and those Delta Duck Club shares, and I think the Delta Duck Club field is still producing. I bought stock in it 40 years ago for $29,200 a share, and it had that amount in cash, and it was producing a lot, and they sold it. If they kept it, that stock might have been worth $2 or $3 million a share, but they sold out to another oil company. But that was certainly that was the most interesting thing. Actually, I didn't have any cash at the time, and I went down and borrowed the money, and I bought it for my wife, and I borrowed the money, and the loan officer said, "Would you like to borrow some money to buy a shotgun as well?" Charlie, tell them about the one you missed.
Well, I have two investments that come to mind. When I was young and poor, I spent $1,000 once buying an oil royalty that paid me $100,000 a year for a great many years. But I only did that once in a lifetime. And on a later occasion, I bought a few shares of Elridge Oil, which went up 30 times rather quickly. But I turned down 5 times as much as I bought. It was the dumbest decision of my whole life. So if any of you have made any dumb decisions, look up here and feel good about yourselves.
So one of Berkshire's biggest investments recently has been Kraft Heinz, the massive packaged food conglomerate. In this answer, Warren and Charlie talk about Kraft Heinz, but they also talk about the retail landscape more generally and how supermarkets are competing with companies like Kraft Heinz. So obviously both of us, Bryce and I, work in retail, and I guess this was a one of personal interest for us as well as investing interest. So hopefully you guys learn something as well.
This question comes from Vincent James of Munich, Germany. There has been a lot written about the recent impairment charge at Kraft Heinz. You were quoted as stating that you recognize that Berkshire overpaid for Kraft Heinz. Clearly, major retail chains are being more aggressive in developing house brands. In addition, Amazon has announced intentions to launch grocery outlets, meaning that, as Mr. Bezos has often stated, your margin is my opportunity. The more fundamental question related to Kraft Heinz may be whether the advantages of the large brands and the zero-based budgeting that 3G has applied are appropriate and defensible at all in consumer foods. In other words, will traditional consumer good brands in general, and Kraft Heinz in particular, have any moat in their future? My question is, to what extent do the changing dynamics in the consumer food market change your view on the long-term potential for Kraft Heinz?
Yeah, actually what I said was we paid too much for Heinz. I mean Kraft, I'm sorry. The Heinz part of the transaction, when we originally owned about half of Heinz, we paid an appropriate price there, and we actually did well. We had some preferred redeemed and so on. We paid too much money for Kraft. To some extent, our own actions had driven up the prices. Now, Kraft Heinz, the profits of that business, $6 billion, we'll say very, very, very roughly. I'm not projecting them out. I'm not making forecasts, but $6 billion pre-tax on $7 billion of tangible assets is a wonderful business. But you can pay too much for a wonderful business. We bought See's Candy, and we made a great purchase as it turned out, and we could have paid more. But there's some price at which we could have bought even See's Candy, and it wouldn't have worked. So the business does not know how much you paid for it. I mean, it's going to earn based on its fundamentals, and we paid too much for the Kraft side of Kraft Heinz. Additionally, the profitability has basically been improved in those operations over the way they were operating before. But you're quite correct that Amazon itself has become a brand. Kirkland at Costco is a $39 billion brand. Now, all of Kraft Heinz does $26 billion, and it's been around for, on the Heinz side, it's been around for 150 years. And it's been advertised billions and billions of dollars in terms of their products, and they go through tens of thousands of outlets. And here's somebody like Costco establishes a brand called Kirkland, and it's doing $39 billion, more than virtually any food company. And that brand moves from product to product, which is terrific if a brand travels. I mean, Coca-Cola moves it from Coke to Cherry Coke and Coke Zero and so on. But to have a brand that can really move, and Kirkland does more business than Coca-Cola does. And Kirkland that operates through 775 or so stores. They call them warehouses at Costco, and Coca-Cola's through millions of distribution outlets. So brands, the retailer and the brands have always struggled as to who gets the upper hand in moving a product to the consumers. And there's no question in my mind that the position of the retailer relative to the brands, which varies enormously around the world in different countries, you've had 35%, even maybe 40% be private label brands and soft drinks, and it's never gotten anywhere close to that in the United States. So it varies a lot. But basically certain retailers, the retail system has gained some power, and particularly in the case of Amazon and Walmart in their reaction to it, and Costco, and Aldi and some others I can name, has gained in power relative to brands. Kraft Heinz is still doing very well operationally, but we paid too much. If we paid $50 billion, it would have been a different business. It'd still be earning the same amount. You can turn any investment into a bad deal by paying too much. What you can't do is turn any investment into a good deal by paying little, which is sort of how I started out in this world. But the idea of buying the cigar butts that have only got that are declining or poor businesses for a bargain price is not something that we try to do anymore. We try to buy good businesses at a decent price, and we made a mistake on the Kraft part of Kraft Heinz. Charlie?
Well, it's not a tragedy that out of two transactions, one worked wonderfully and the other didn't work so well. That happens.
The reduction in costs, there can always be mistakes made when you've got places and you're reorganizing them to do more business with the same number of people. And we like buying businesses that are efficient to start with, but it's, the management, the operations of Kraft Heinz have been improved under the present management overall. But we paid a very high price in terms of the Kraft part. We paid an appropriate price in terms of Heinz.
So, Ren, moving from retail to banks, it was the Wells Fargo Golf International Championship over the weekend. And that's not what this question is about, but I just thought I'd point it out because Buffett is also the biggest shareholder of Wells Fargo, a large American bank. And this question is challenging him on why they didn't take a tougher stance against the company when Wells Fargo were busted in a big fraud case.
This is a question that comes from Mike Hebel. He says, the Star Performers Investment Club has 30 partners, all of whom are active or retired San Francisco police officers. Several of our members have worked in the fraud detail and have often commented after the years-long fraudulent behavior of Wells Fargo employees should have warranted jail sentences for several dozen. Yet Wells just pays civil penalties and changes management. As proud shareholders of Berkshire, we cannot understand Mr. Buffett's relative silence compared to his vigorous public pronouncement many years ago on Solomon's misbehavior. Why so quiet?
Yeah, I would say this. As I see it, although I have read no reports internally or anything like that, but it looks to me like Wells made some big mistakes in what they incentivize. And as Charlie says, there's nothing like incentives, but they can incentivize the wrong behavior. And I've seen that a lot of places, and that clearly existed at Wells. The interesting thing is, to the extent that they set up fake accounts, a couple million of them that had no balance in them, that could not possibly have been profitable to Wells. So you can incentivize some crazy things. The problem is, I'm sure, is that, and I don't really have any insider information on it at all, but when you find a problem, you have to do something about it. And I think that's where they probably made a mistake at Wells Fargo. They made it at Solomon. I mean, John Goodfriend would never have played around with the government. He was the CEO of Solomon in 1991. He never would have done what the bond trader did, that played around with the rules that the federal government had about government bond bidding. But when he heard about it, he didn't immediately notify the Federal Reserve. And he heard about it in late April, and May 15th, the government bond auction came along, and Paul Moser did the same thing he'd done before and gamed the auction. And at this point, John Goodfriend, the destiny of Solomon was straight downhill from that point forward, because essentially he heard about a pyromaniac, and he'd let him keep the box of matches. And at Wells, my understanding, there was an article in the Los Angeles Times maybe a couple of years before the whole thing was exposed, and somebody ignored that article. And Charlie has beaten me over the head all the years at Berkshire, because we have 390,000 employees, and I will guarantee you that some of them are doing things that are wrong right now. There's no way to have a city of 390,000 people and not need a policeman or a court system. And some people don't follow the rules, and you can incentivize the wrong behavior. You've got to do something about it when it happens. Wells has become, Exhibit 1 in recent years, but if you go back a few years, you can almost go down. There's quite a list of banks where people behave badly, and where I would not say, I don't know the specifics at Wells, but I've actually written in the annual report that they talk about moral hazard if they allow people the shareholders of Wells have paid a price, the shareholders of Citicorp paid a price, the shareholders of Goldman Sachs, the shareholders of Bank of America, they paid billions and billions of dollars, and they didn't commit the acts. And of course, nobody did go. There were no jail sentences, and that is infuriating. But the lesson that was taught was not that the government bailed you out, because the government got its money back, but the shareholders of the various banks paid many, many billions of dollars. And I don't have any advice for anybody running a business, except when you find out something is leading to bad results or bad behavior, if you're in the top job, you've got to take action fast. And that's why we have hotlines. That's why when we get certain anonymous letters, we turn them over to the audit committee or to outside investigators, and I will guarantee you that we will have some people who do things that are wrong at Berkshire in the next year, 5 years, 10 years, and 50 years. You cannot have 390,000 people. And it's the one thing that always worries me about my job, because I've got to hear about those things, and I've got to do something about them when I do hear about them. Charlie?
Well, I don't think people ought to go to jail for honest errors of judgment. It's bad enough to lose your job. And I don't think that any of those top officers was deliberately malevolent in any way. We're talking about honest errors in judgment. And I don't think Tim Sloan even committed honest errors of misjudgment. I just think he was an accidental casualty that didn't deserve the trouble.
Yeah,
I wish this Tim Sloan was still there.
Yeah, there's no evidence that he did a thing, but he stepped up to take a job where he was going to be a piñata, basically, for all kinds of investigations, and rightfully Wells should be checked out on everything they do. All banks should. I mean, they get a government guarantee, and they receive trillions of dollars in deposits, and they do that basically because of the FDIC, and if they abuse that, they should pay a price. And if anybody does anything like a Paul Moser did, for example, of Solomon, they ought to go to jail. Paul Moser only went to jail for 4 months, but if you're breaking laws, you should be prosecuted on it. If you do a lot of dumb things, I wish they wouldn't go away, the CEOs wouldn't go away so rich under those circumstances, but people will do dumb things. I actually proposed, I think it may have been in one of the annual reports even, I proposed that if a bank gets to where it needs government assistance, that basically the responsible CEO should lose his net worth and his spouse's net worth if he doesn't want the job under those circumstances. And I think that the directors, I think they should come after the directors for the last 5 years. I think I proposed of everything they've received. But it's the shareholders who pay. I mean, if we own 9% of Wells, whatever this has cost, 9% of it is being borne by us, and it's very hard to tie it directly. One thing you should know, incidentally, though, is that the FDIC, which was started, I think it was started January 1st, 1934, but it was a New Deal proposal, and the FDIC has not cost the United States government a penny. It now has about $100 billion in it, and that money has all been put in there by the banks, and that's covered all the losses of hundreds and hundreds and hundreds of financial institutions. And I think the impression is that the government guarantees saved the banks, but the government money did not save the banks. The banks' money as an industry not only have paid every loss, but they've accumulated an extra $100 billion, and that's the reason the FDIC assessments now are going back down. They had them at a high level, and they had a higher level for the very big banks. So when you hear all the talk about the political talk about the banks, they have not cost the federal government a penny. There were a lot of actions that took place that should not have taken place. And there's a lot fewer now, I think, than there were in the period leading up to 2008 and 9. But some banks will make big mistakes in the future. Charlie?
I've got nothing to add to that.
Okay.
So interesting answer from Warren there. Starts by defending the bank and defending the bank CEO, and then ends by saying that bank CEOs should be personally liable for the losses that their banks incur. So a little bit of a varied answer there, but hopefully it got everyone thinking about the issue. Anyway, moving on. The next question is about 5G, the technology. But why we've included this is because towards the end of it, Warren and Charlie talk about change generally in the economy and in the world and what that's meant for their investing career, because Warren started investing in the 50s. You think about the technological change, the industries that have risen and died in that time. So I thought this was a really interesting perspective on long-term investing and how you manage the rise and falls of industries.
Hello, Charlie Munger and Warren Buffett, my idols. I'm Terry from Shanghai Judge PE Fund, which aim to catch the best investment opportunity in next era. So my question is, as we all know, 5G is coming. It is said that the mode of all industry will be challenged in 5G era. So what is the core competence that we should master if Berkshire Hathaway wants to catch the best investment opportunities in next era? Thank you.
Well, there's no core competence at the very top of Berkshire. The subsidiaries that will be involved in developments relating to 5G or any one of all kinds of things that are going to happen in this world, the utility of LNG in the railroad, or all those kinds of questions. We have people in those businesses that know a lot more about them than we do, and we count on our managers to anticipate what is coming in their business, and then sometimes they talk to us about it. But we do not run that on a centralized basis. And Charlie, do you want to have anything to add to that? Do you know anything about 5G? I don't know. Well, you probably know a lot about 5G.
No, I know very little about 5G. But I do know a little about China. And we have bought things in China, and my guess is we'll buy more.
Yeah. But, I mean, we basically want to have a group of managers, and we do have a group of managers who are on top of their businesses. I mean, you saw something that showed BNSF and Berkshire Hathaway Energy and Lubrizol all there. Those people know their businesses. They know what changes are likely to be ahead. Sometimes they find things that they can cooperate on between their businesses, but we don't try to run those from headquarters. And that may have certain weaknesses at certain times. I think net it's been a terrific benefit for Berkshire. Our managers, to a great degree, own their businesses, and we want them to feel a sense of ownership. We don't want them to be lost in some massive conglomerate and where they get directions from this group, which is a subgroup of that group. And I could tell you a few horror stories from companies we bought when they tell us about their experience under such an operation. So the world is going to change in dramatic ways. Just think how much it's changed in the 54 years that we've had Berkshire. And some of those changes hurt us. They hurt us in textiles. They hurt us in shoes. They hurt us in the department store business. Hurt us in the trading stamp business. These were the founding businesses of this operation. But we do adjust, and we've got a group overall of very good businesses. We've got some that will be actually destroyed by what happens in this world. But that's, I still am the card-carrying capitalist, and I believe that's a good thing. You have to make changes. We had 80% of the people working on farms in 1800. And if there hadn't been a lot of changes, and you needed 80% of the people in the country producing the food and cotton we needed, we would have a whole different society. So we welcome change, and we certainly want to have managers that can anticipate and adapt to it, but sometimes we'll be wrong, and those businesses will wither and die, and we better use the money someplace else.
So, Ren, there was a while there where Buffett and Charles were always talking about investing in things they know, and tech wasn't high on their priority list. This question was aimed at their recent investment in Amazon, but it's interesting to note that throughout the answer, Charlie discusses how they missed out on investing in Google, and it's probably one of their biggest investing regrets to date.
This question is from Ken Scarbeck in Indianapolis. He says, with the full understanding that Warren had no input on the Amazon purchase and that relative to Berkshire, it's likely a small stake, the investment still caught me off guard. I'm wondering if I should begin to think differently about Berkshire looking out, say, 20 years. Might we be seeing a shift in investment philosophy away from value investing principles that the current management has practiced for 70 years? Amazon is a great company, yet it would seem its heady shares 10 years into a bull market appear to conflict with being fearful when others are greedy. Considering this and other recent investments like StoneCo, should we be preparing for a change in the price versus value decisions that built Berkshire?
Yeah, it's interesting that the term value investing came up, because I can assure you that both managers and one of them bought some Amazon stock in the last quarter, which will get reported in another week or 10 days. He is a value investor. The idea that value is somehow connected to book value or low price earnings ratios or anything, as Charlie has said, all investing is value investing. I mean, you're putting out some money now to get more later on, and you're making a calculation as to the probabilities of getting that money and when you'll get it and what interest rates will be in between, and all the same calculation goes into it, whether you're buying some bank at 70% of book value or you're buying Amazon at some very high multiple of reported earnings. Amazon, the people making the decision on Amazon are absolutely much value investors, as I was when I was looking around for all these things selling below working capital years ago. So that has not changed. The two people that, one of whom made the investment in Amazon, they are looking at many hundreds of securities, and they can look at more than I can because they're managing less money, and their universe, possible universe, is greater. But they are looking for things that they feel they understand what will be developed by that business between now and Judgment Day in cash. And it's not sales. Current sales can make some difference. Current profit margins can make some difference. Tangible assets, excess cash, excess debt, all of those things go into making a calculation as to whether they should buy A versus B versus C. And they are absolutely following value principles. They don't necessarily agree with each other or agree with me, but they are very smart. They are totally committed to Berkshire, and they're very good human beings on top of it. So I don't second guess them on anything. Charlie doesn't second guess me on. In 60 years, he's never second guessed me on an investment. And the considerations are identical when you buy Amazon versus some, say, bank stock that looks cheap statistically against book value or earnings or something of the sort. In the end, it all goes back to Aesop, who in 600 BC said, that a bird in the hand is worth two in the bush. And when we buy Amazon, we try and figure out whether, or the fellow that bought it tries to figure out whether there's 3 or 4 or 5 in the bush, and how long it'll take to get to the bush, how certain he is that he's going to get to the bush, and then who else is going to come and try and take the bush away, and all of that sort of thing. And we do the same thing, and it really, despite a lot of equations you'll learn in business school, the basic equation is that of Aesop, and your success in investing depends on how well you were able to figure out how certain that bush is, how far away it is, and what the worst case is. Instead of two birds being there, only one being there, and the possibilities of 4 or 5 or 10 or 20 being there. And that will guide me, that will guide my successors in investment management at Berkshire, and I think they'll be right more often than they're wrong. Charlie?
Well, Warren and I are a little older than some people, and
near everybody.
And we're not the most flexible, probably, in the whole world. And of course, if something as extreme as this internet development happens, and you don't catch it, why, other people are going to blow by you. And I don't mind not having caught Amazon early. The guy is kind of a miracle worker. It's very peculiar. I give myself a pass on that. But I feel like a horse's ass for not identifying Google better. I think Warren feels the same way.
Yeah.
We screwed up.
He's saying we blew it. And we did have some insights into that because we were using them at GEICO, and we were seeing the results produced, and we saw that we were paying $10 a click or whatever it might have been for something that had a marginal cost to them of exactly zero, and we saw it was working for us. So
we can see in our own operations how well that Google advertising was working, and we just sat there sucking our thumbs.
Right.
So we're ashamed. We atone. We're trying to atone. Maybe Apple was atonement.
When he says sucking our thumbs, I'm just glad he didn't use some other example.
There we go. A little bit of a cheeky joke there from Warren to finish it off. Aside, the joke aside, I really like the answer from Charlie, and I think it goes to something that we've talked about before, and Peter Lynch talks about in his book One Up on Wall Street, how sometimes the best investments are things that you're using and things that you see around you. And Charlie and Warren were using Google at Geico. They recognized its value. They recognized the economic proposition for Google. You know, there was next to no marginal cost for each incremental customer, but there was a lot of value created for each incremental customer. And yet they didn't invest.
Yeah, fascinating.
Even the best investors of all time can miss it sometimes. So it always pays to keep a sharp eye on what you're using and what's creating value for you. Anyway, speaking of creating value, private equity has sucked up a lot of money recently. And for those who aren't familiar with what it is, just think of it as private pools of capital, just massive amount of capital, billions and billions of dollars, that just try and find ways to earn yield, just earn returns for their investors. Warren and Charlie were asked a question on private equity funds and what they thought about them as investment vehicles, especially for big funds like superannuation funds and pension funds.
Warren and Charlie, my name is Brent Muyo. I'm from Winnipeg, Canada. First, thank you for devoting so much time and energy to education. I'm a better investor because of your efforts. But more importantly, I'm a better partner, friend, son, brother, and soon-to-be first-time father. There's nothing more important than these relationships, and my life is better because you're willing to pass on your experience and wisdom. My path into finance was unconventional. I worked as an engineer for 12 years, while 2 years ago I began a career in finance, working for the Civil Service Superannuation Board, a $7 billion public pension fund in Winnipeg. I work on alternative investments, which include infrastructure, private equity, and private credit. I go to work every day knowing that I'm there to benefit the hardworking, current, and future beneficiaries of the fund. Like most asset classes, alternative purchase multiples have increased. More of these assets are funded with borrowed money, and the terms and covenants on this debt are essentially non-existent. With this in mind, and knowing the constraints of illiquid, closed-end funds, please give me your thoughts on private alternative investments, their relevancy in public pension funds, and your view on long-term return expectations.
Yeah, if you would leveraged up investments in just common stocks, and you'd figured a way so that you would have staying power if there were any market dip. I mean, you'd obviously have obtained extraordinary returns. I pointed out in my investing lifetime, you know, an index fund would do 11%. Well, imagine how you'd have done if you'd leveraged that up 50%, whatever the prevailing rates were over time. So a leveraged investment in a business is going to beat an unleveraged investment in a good business a good bit of the time. But as you point out, the covenants to protect debt holders have really deteriorated in the business. And of course, you've been in an up market for businesses, and you've got a period of low interest rates. So it's been a very good time for it. My personal opinion is if you take unleveraged returns against unleveraged common stocks, I do not think what is being purchased today and marketed today would work well. But if you can borrow money, if you can buy assets that will yield 7 or 8%, and you can borrow enough money at 4 or 5%, and you don't have any covenants to meet, you're going to have some bankruptcies, but you're going to also have better results in many cases. It's not something that interests us at all. We are not going to leverage up Berkshire. If we leveraged up Berkshire, we'd have made a whole lot more money, obviously, over the years. But both Charlie and I probably have seen some more high IQ people, really extraordinarily high IQ people, destroyed by leverage. We saw long-term capital management where we had people who could do in their sleep math that we couldn't do, or at least I couldn't do, working full-time at it during the day. And I mean, really, really smart people working with their own money and with years and years of experience of what they were doing. And it all turned to pumpkins and mice in 1998. And he actually was a source of national concern, just a few hundred people. And then we saw some of those same people after that happened to them once go out and do the same thing again. So it's, I would not get excited about so-called alternative investments. You can get all kinds of different figures, but there's probably at least $1 trillion committed to buying, in effect, buying businesses. And if you figure they're going to leverage them, 2 for 1 on that, you may have $3 trillion of buying power trying to buy businesses in the U.S. market may be something over $30 trillion now, but there's all kinds of businesses that aren't for sale and that thing. So the supply-demand situation for buying businesses privately and leveraging them up has changed dramatically from what it was 10 or 20 years ago. And I'm sure it doesn't happen with your Winnipeg operation, but we have seen a number of proposals from private equity funds where the returns are really not calculated in a manner that, they're not calculated in a manner that I would regard as honest. And so it's not something. If I were running a pension fund, I would be very careful about what was being offered to me. If you have a choice in Wall Street between being a great analyst or being a great salesperson, the salesperson is the way to make it. If you can raise $10 billion in a fund and you get a 1.5% fee and you lock people up for 10 years, you and your children and your grandchildren will never have to do a thing if you are the dumbest investor in the world. Charlie?
Well, I think what we're doing will work more safely than what he's doing. But I wish him well.
Yeah, Brent, you sound like a guy that I would hope would be working for a public pension fund, because frankly, most of the institutional funds, we had this terrible right here in Omaha, and you can get a story of what happened with our Omaha Public Schools retirement fund, and they were doing fine, and until the manager started going in a different direction, and the trustees here, perfectly decent people, and the manager had done okay to that point, and it became.
They were smarter in Winnipeg than they are here.
Yeah, well,
that was pretty bad here.
It's not a fair fight, actually, usually when a bunch of public officials are listening to people who are motivated to, who really just get paid for raising the money. Everything else is gravy after that. But if you run a fund and you get even 1%, of $1 billion, you're getting $10 million a year coming in, and if you've got the money locked up for a long time, it's a very one-sided deal. And I told the story of asking the guy one time in the past, why in the world can you ask for 2 and 20 when you really haven't got any kind of evidence that you are going to do better with the money than you do in an index fund? And he said, well, that's because I can't get 3 and 30.
What I don't like about a lot of the pension fund investment is I think they like it because they don't have to mark it down as much as it should be in the middle of the panics. I think that's a silly reason to buy something, because you're given leniency in marking it down.
Yeah, and when you commit the money, in the case of private equity often, they don't take the money, but you pay a fee on the money that you've committed. And of course, you really have to have that money to come up with it at any time. And of course, it makes their return look better if you sit there for a long time in treasury bills, which you have to hold because they can call you up and demand the money, and they don't count that. They count it in terms of getting a fee on it, but they don't count it in terms of what the so-called internal rate of return is. It's not as good as it looks, and I really do think that when you have a group sitting as a state pension fund,
Warren, all they're doing is lying a little bit to make the money come in.
yeah, well, that sums it up.
Yeah.
So second last one is on delayed gratification, how you basically can learn to be a long-term investor.
Hey Warren and Charlie, I'm Neil Nerona. I'm 13 years old and from San Francisco. I feel like I see you in our living room a lot. My dad is constantly playing these videos of you at these meetings. And he teaches me a lot of lessons about you guys. But many of them require the delayed gratification skill. I want to know, is there any way that kids can develop the delayed gratification skill?
I'll take it if you want me to.
Oh man, I'm shivering.
I'll take that because I'm a specialist in delayed gratification. I've had a lot of time to delay it. And my answer is that they sort of come out of the womb with the delayed gratification thing, or they come out of the womb where they have to have everything right now. And I've never been able to change them at all. So we identify it, we don't train it in.
Charlie's had 8 children, so he's become more and more of a believer in nature versus nurture.
You'll probably find some nice old woman of about 95 out there in threadbare clothing, and she's delaying gratification right to the end and probably has 4,000 A shares. It's just these second and third generation types that are buying all the jewelry.
It's interesting, if you think about, we'll take it to a broader point, but if you think of a 30-year government bond paying 3%, and you allow for, as an individual, paying some taxes on the 3% you'll receive, and you'll have the Federal Reserve Board saying that their objective is to have 2% inflation, you'll really see that that delayed gratification, if you own a long government bond, is that you get to go to Disneyland and ride the same number of rides 30 years from now that you would if you did it now. The low interest rates for people who invest in fixed dollar investments really mean that you really aren't going to eat steak later on if you eat hamburgers now, which is what I used to preach to my wife and children and anybody else that would listen many years ago. So I don't necessarily think that for all families in all circumstances that saving money is necessarily the best thing to do in life. I mean, if you really tell your kids they can, whatever it may be, they never go to the movies or will never go to Disneyland or something of the sort, because if I save this money 30 years from now, well, will be able to stay a week instead of 2 days. I think there's a lot to be said for doing things that bring you and your family enjoyment rather than trying to save every dime. I advise delayed gratification is not necessarily an unqualified course of action under all circumstances. I always believed in spending 2 or 3 cents out of every dollar I earned, saving the rest. But I've always had everything I wanted. I mean, one thing you should understand, if you aren't happy having $50,000 or $100,000, you're not going to be happy if you have 50 million or 100 million. I mean, a certain amount of money does make you feel, and those feel around you feel better, just in terms of being more secure in some cases. But loads and loads of money. I've probably known as many rich people as just about anybody, and I don't think they're happier because they get super rich. I think they are happier when they don't have to worry about money. But you don't see a correlation between happiness and money beyond a certain place. So don't go overboard on delayed gratification.
Nice one. This has been good, Ren. So we're now just about to come to the halfway mark of the 7-hour marathon of question and answer with Charles and Warren. And so we thought we'd finish with a question that was to do with Bitcoin. And this we'll join the conversation halfway through an answer here, because Charlie is just about to go on a tangent on his thoughts on Bitcoin and really fascinated by this answer. So this is our last question, and we'll let you listen to the remaining 3.5 hours, Ren, and hopefully come back with the next lot.
Yeah, sounds good.
And I also want to report that your vice chairman is getting new social distinction. I've been invited during this gathering to go to a happy hour put on by the Bitcoin people. And I've tried to figure out what the Bitcoin people do in their happy hour, and I finally figured it out. They celebrate the life and work of Judas Iscariot.
Is your invitation still good? Well, Bitcoin, actually, on my honeymoon in 1952, my bride, 19, and I, 21, stopped in Las Vegas. My Aunt Alice gave me the car and said, have a good time, and we went west. So we stopped in the Flamingo, and I looked around, and I saw all of these well-dressed, they dressed better in those days, well-dressed people who had come, in some cases, thousands of miles away. And this was before jets, so transportation wasn't as good. And they came to do something that every damn one of them knew was mathematically dumb. And I told Susie, I said, we are going to make a lot of money. I mean, imagine people going to stick money on some roulette number with a 0 and a 00 there and knowing the percent. They all could do it, and they just do it. And I have to say, Bitcoin has rejuvenated that feeling in me.
So there you go. Not good news for anyone still holding cryptocurrency out there, unless you want to bet against Warren Buffett, but he's certainly betting against you. So take that how you will. So that is the end of our part 1 of the Berkshire Hathaway annual meeting, or at least the Q&A part of it. Hopefully you guys have got something out of it. These are the 2 greatest investors, I would say, of all time. You know, we get a chance to listen to them share some thoughts, so hopefully you enjoy listening to them as much as we do. And if you do, next Monday, listen to the second half of it.
And if you do, how's this for a pledge, Ren, that next year's Equity Mates celebration party will be in Omaha, United States? Is that where he holds it? Or he holds it in Vegas?
No. It's in Omaha.
Yeah, it's in Omaha.
Yeah.
So if we get enough people joining the show, helping us go full time, quitting our jobs, and getting us on the road to the share market guys worldwide, Equity Mates worldwide, then we'll do this live next year in Omaha.
I like it. We threw a bunch of the money we've made from advertising behind the bar for our party this year.
Yep.
Next year we'll give back to our listeners by maybe not flying all of them over, but we'll fly at least some of them over.
Yep.
As long as people keep listening, I guess.
Absolutely. And getting everyone on board.
Well, I guess if people stop listening, there'll be less flights we need to buy, so...
True. Could be just you and I without the mics.
Yeah. But no, I think I look forward to seeing you there.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.
Equity Mates.